The S&P 500 finished the first half in the green, which is quite astonishing considering just in mid-April, we were looking at an S&P 500 down more than 15%. The rally back has been swift and it's been broad. A lot of sectors have been participating, but not all sectors. As you can see here, this is the sector performance for the 11 sectors within the S&P 500 on a year-to-date perspective. The best performing sectors have been industrials, technology, and communication services. The worst performing sectors have been consumer discretionary, healthcare, and real estate, with the first two being the only sectors in the red so far. But the third worst performing has been real estate, which is what we're focusing on today. And one of the most popular REITs on the planet is Realty Income, known as the Monthly Dividend Company, as they pay out their annual dividend in monthly installments. Monthly dividend, that's great. It's not something that I'm always looking for or really looking for at all. Instead, I'm looking for total return and performance. And when it comes to Realty Income, the returns have been muted. So I think it's time for us to take a fresh look at Realty Income to see, is it time to sell or is it time to buy more? And I'll be talking about 3 of my favorite REITs as well at the end of the video. So make sure you stay tuned throughout the entirety so you don't miss any of it. And do me a huge favor before we begin, simply click that like button down below as it really helps the growth of the channel, and consider subscribing so you're notified anytime we drop new content, and let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is the Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. Right now, if you go to fool.com/Mark, you could check out their 10 best stocks to buy right now. All right, let's jump back into our video, taking a closer look at Realty Income and deciding what should we do with this particular REIT, and then we'll end the video talking about a few of my favorite REITs. Is Realty Income on the list? All right, so for those of you unaware, Realty Income is known as a net lease retail REIT. They own properties, shopping centers, retail centers with many tenants such as dollar stores, 7-Eleven, Home Depot, pharmacies like CVS, Walgreens, and such. In return, the term net lease means that tenants not only pay for their monthly rent, but they also cover property taxes, insurance, and maintenance costs. So really, Realty Income is sitting back as long as their properties are leased and they're collecting rent checks. The company does enter into long-term leases though, as the average lease term for Realty Income is more than 10 years out. This helps from a cash flow perspective and consistency for investors. However, if we go through a period in which rent prices spike, which we have seen in recent years, they could be stuck with below market rents, meaning that if they were to go out and sign a fresh lease today, they could be earning more money. So there is some downside to these longer duration leases. When it comes to Realty Income, they currently have a market cap of $51 billion. Over the past 12 months, shares are up pretty much nothing, 0.3% in the green. However, over the past 5 years, shares are actually down nearly 5%. But those juicy dividends, which we will look at here in a second, is what has bailed the company out. Had you invested $10,000 into shares of Realty Income 5 years ago, although the stock price is negative, your investment would have grown to nearly $13,000. And speaking of that dividend, as I mentioned, it was juicy, as they currently yield a dividend of nearly 6%. They pay out $3.23 per share on an annual basis, but it's paid out in monthly installments. And they have been growing their dividends for more than 30 years, which means they're a dividend aristocrat, which is rare for REITs. Taking a closer look at the REIT, you can see that it's the 7th largest global REIT, and they have an A- credit rating with the S&P. On the bottom right of this figure, you can see the company has paid 658 monthly dividends, and they've been increasing those dividends on a quarterly basis, 110 consecutive quarters. So let me pause real quick and again mention that Realty Income is a position currently in my portfolio. They've been a fantastic, well-run company. I've had the great honor of interviewing the CEO on a number of different occasions. However, when it comes to me and my portfolio and my goals each and every year is to outpace the S&P 500. And I've been able to do that for 9 of the past 10 years. Can I say Realty Income has really helped me get there? I can't. And I must note that when you decide to sell a stock, it doesn't always necessarily mean you dislike the company or dislike the management. It may just not be fitting your overall strategy. I like a lot of things about Realty Income. Again, a great management team, great properties that are in demand with a solid high yield dividend. But what I have to ask myself as I manage my own portfolio is the money that's currently invested in Realty Income, could it be better served somewhere else? The company is not dwindling. The shares aren't expensive. In fact, some could say they're cheap. But the stock is not helping me get towards my total return strategy. The growth just isn't there like it used to be, and I don't see it picking up all that much. So if anything right now, I rate shares a hold, but I will premise with this. I will be trimming some of my position. But just because I say that doesn't mean that's a decision you have to make, because you could have a completely different strategy. You could be more focused on dividend, more focused on yield, less focused on higher growth, more focused on less volatility, and Realty Income can check a lot of those boxes. Since I just mentioned valuation, let's take a peek. Over the past decade, shares have traded at an average AFFO multiple of 16.7 times. Today, you can pick up shares for 13.2 times, well below their historical average. However, my argument when it comes to Realty Income is for years, this is a company that has commanded a premium to its sector, to the retail net lease sector. And I don't think the growth is there anymore. I don't think as much of the safety is there like it used to be. So are they just more of middle of the pack? Or could we say they earn a slight premium, maybe a 15 times multiple? So when we look now here at the AFFO estimates from analysts, the average 2025 AFFO estimate is $4.25 per share. If we multiply that by a 15 times multiple, that would equate to a stock price of around $64 per share, giving the stock between 10 to 12% upside from current levels. Again, not terrible considering that return goes along with a near 6% dividend. So we would really need investors to be willing to put a premium back on this name above the rest of the group, which isn't something we have seen for a number of years now. So again, the strategy that I'm implying is going to be reducing some of my position in the near term of Realty Income, because I believe that money that I'm going to sell out of could be better used elsewhere. And right now I'm going to quickly go through 3 of my favorite REITs where I'll be employing some of this money and additional funds. The 3 REITs on my list are going to include Prologis, stock ticker PLD, Equinix, stock ticker EQIX, and Vici Properties, stock ticker VICI. I'm not going to go into depth of all 3 of these REITs because that's not what today's video was, but I'll touch quickly on each of them, beginning with Prologis, which is a warehouse logistics REIT. This is a way for you to play the growth in e-commerce. If you believe that e-commerce sales are going to continue to penetrate overall retail sales, this is going to be a REIT that's going to benefit greatly. And they're also getting more into data centers. And they also pay a solid dividend and a fast-growing dividend, a rarity in the REIT world. Speaking of that dividend, you could see Prologis shares currently yield a dividend of 3.7% to go along with a 5-year dividend growth rate of 12.4%. The other REIT that I mentioned was Equinix, stock ticker EQIX. They are a data center REIT. This is a way, yet another way, to play the growth in AI. And this is a company, a REIT, that also is rare in the fact that they also pay a fast-growing dividend. As you can see here, the company pays a 2.5% dividend with a 5-year dividend growth rate of near 12%. The last REIT that I'm going to mention is Vici Properties, stock ticker VICI, and this happens to be the largest REIT currently in my portfolio. I will premise with PLD will likely be the largest very soon. But for those of you unaware, Vici Properties is the largest landlord on the Las Vegas Strip. They own properties such as Caesars Palace, MGM Grand, Park MGM, the Mirage, and they're currently under construction for a new state-of-the-art Hard Rock Casino. In terms of the dividend, the company pays a high yield of 5.2% with a 5-year dividend growth rate near 8%. So you're not getting as fast of dividend growth, but still pretty solid, outpacing inflation. And the REIT has paid a growing dividend every year it has been a public company. So there we just looked at and took a closer look at Realty Income, and I discussed what my game plan was. Doesn't mean that has to be your game plan, because you may have a different strategy. But I'm going to be looking to reduce my position in Realty Income. This is a company that's not growing like it once did. And I believe that that money could be better suited elsewhere. And I mentioned 3 of my favorite REITs where some of that money is going to be put to use. In the comment section, let me know, what do you rate Realty Income? A buy, sell, or hold? And what are some of your favorite REITs to invest in outside of O? Thanks again for watching, and hopefully if you enjoyed the video, you can click that like button down below as it really helps the growth of the channel, and subscribe, and we'll see you in the next one. Take care.